Hello and welcome to SwitzerTV. I'm Paul Rickard. In the lead up to Christmas, we want to get out the crystal ball, look at the Australian economy and ask the question, where are bank shares heading? So let's start with the Australian economy and our crystal ball on that. Australian economy is very strong. In fact, the latest growth figures of 3.4% surprised many. That's largely due to the real strength in net exports. That's led to the IMF to upgrade its forecast next year for growth at 3.1%. Growth above 3% is pretty good. The employment market is really robust. Unemployment down to 5%. That's the lowest in a number of years. Company profits are also record high. So they're all very positive factors about the Australian economy. Business conditions, and confidence have come off a little bit, but they're still strong. In fact, business confidence at 6.2, still above the long-term average of just over 6. Consumer confidence has also dipped recently, thanks, I guess, mainly due to the concerns about the housing market and lack of wages growth, but wages growth is starting to accelerate. Retail turnover remains weak, and credit growth is still pretty benign, particularly in the housing market. Putting all those together in terms of a budgetary position for the Australian government, the budget deficit is tumbling. Some say it could almost be in a surplus by this time next year. That's sort of the factors as we know them in the Australian economy at the moment. What does that mean for markets? Well, for interest rates, they look on a hold at 1.5%. The Reserve Bank hasn't moved that now in over two and a half years. Some people say they won't be moving it till the start of 2020. My guess is we'll start to see an increase sometime in 2019, particularly if US interest rates continue to go up and growth surprises on the high side. The dollar, a lot of people calling the dollar to go below 70 cents. It's found an enormous space at 70 cents. Net exports seem to be providing support. My guess is it's going to stay, it's found a floor at 70 cents. That's around fair value. Notoriously hard to actually call the dollar where it's going to head, but I think we've got support there. And what is it all, putting all those factors together, should that mean for the Australian share market? Well, if economic growth is strong, company profits are strong, that should be good for Australian equities, notwithstanding the leads from the US. So that brings me on to the US. Where's the US market heading? Well, the underlying US economy is really strong, growth is high, employment is really strong, company profits are up. Those factors should all be supportive for US equity markets, and the rally should continue. Against that, we've got a factor called President Trump. That can either be a positive or a negative for the markets. We know there's a trade spat on with China, that we also know that he wants to throw out some curveballs. We also know that the US Fed is increasing interest rates at a pace that he thinks is uncomfortable. My guess overall, though, as he's proven the last 2 years or so, is he's likely to be more supportive for equities than negative, and I think putting all that together, the US market goes higher. That means the Australian market can also go higher. Let's move on to the outlook for Australian banks. We've now had full-year reports from the ANZ, National Australia Bank and Westpac. While the cash profit was down in each case, it met or marginally exceeded analysts' expectations. The ANZ reported a cash profit down 5% to $6.5 billion, National Australia Bank a cash profit down 14% to $5.7 billion, and Westpac was flat at $8.1 billion. We also had a strong first half year result from Macquarie of $1.3 billion, and they're on track for an increase for this financial year of 10% compared to last year. What were some of the common themes for the major banks? Well, first of all, the capital position is strong. Each of the major banks is on target or already there in terms of reaching APRA's unquestionably strong rating. Secondly, dividends have been maintained, and in most cases, the dividend outlook looks pretty secure, perhaps a little more secure now than it did, say, 12 months ago. There's no sign of any uptick in bad debts, or there's no sign of any accelerating mortgage stress, so credit issues are really under control. And finally, each of the major banks is working on cost reduction initiatives. They're accelerating those. They're simplifying their processes, cutting their products, really working on the bottom line to get it into better shape. They're all the positives. The negatives in the results, well, each of the major banks had a weak second half, and that really showed the signs of both volumes. In other words, volumes in home loans are falling or not growing because of the pressures in the market, and also margins, partly for some pressures around funding, but also particularly with the home loans as borrowers switch from higher yielding or higher margin interest only loans to principal and interest loans for the home loan book. That switching is going to continue and probably going to put downward pressure on margins in the short term. And then thirdly, each of the major banks has released a provision for customer remediation costs. That's coming out of the Royal Commissions, particularly things like fees for no service. The question the market has is it enough? So that's a summary of the positives and the negatives. So summing up where the crystal ball's at, well, I think President Trump's actions are more likely to be supportive rather than negative for equities. So the rally in the United States continues. That provides support for the Australian market. A Christmas, some sort of Santa Claus rally is on the cards. However, as we move into 2019, the electoral cycle in Australia will come into play, and that will temper enthusiasm for Australian equities. And on the bank side, banks are cheap. We've still got a lot of negatives with the Royal Commission and the findings to come out, but I think in dips, banks look like good buying. That's our crystal ball. Thanks for joining us on SwitzerTV.